We have the Taiwanese index, which is absolutely on the flat line with some positive bias.
I mean, you could expect a little bit of a sideways price action like what we've seen over the last two sessions.
Tata Motors is clearly doubling down on its electric vehicle foray.
But at the moment, the market is focused on increasing interest rates in the States.
We are very, very pleased with what you have done in terms of the entire year.
Up almost 20-odd points on the Nifty. The mid-cap index is flat with a bit of a positive bias.
We see this still as a range-bound market. Not too much of upside, not too much of downside.
There's several kinds of incentives available for consumers who are looking to buy EVs in India.
Titan is looking to, benefit from that by announcing its gold price lock-in scheme.
While the market continues to be range-bound, I think a lot of the action has shifted to mid-caps.
5.3% constant currency quarter-on-quarter revenue growth. Year-on-year, it's approaching a 20% growth.
Motilal Oswal has initiated coverage on Paytm by recommendation.
The first store opened in Mumbai, which is Apple BKC, and this is Apple Saket.
The mid-cap index is up 23 points, so the mid-cap outperformance actually continues.
That was the day so far. Hello and welcome to Closing Bell, live from the CNBC-TV18 Motilal Oswal studio. I'm Rima Tendulkar, with me, Surbhi, Nigel, and we've got Mangalam in the newsroom. Good afternoon. Another flat range-bound session. The little bit of volatility we saw in the first 1 hour of trade, where the Nifty fell from the day's high. But after that, from 10:30 p.m. to 2:30 p.m., that's 4 hours, the Nifty's practically moved in a 50-point range, just meandering between the red and the green line, absolutely flat-lining. And that's the picture even right now. This is as quiet can be. 17,600 on the benchmark indices. The sensex is at 59,550. Mid-caps were faring relatively better, but now that advantage is also gone. Though for the week so far, we've seen the mid-cap index outperform the Nifty by close to about 2.5%. The week-to-date numbers will also come up for you on your screen. Sectorally, pharma is taking a bit of a leg down. The Nifty Pharma Index is down 1%, so coming in for some profit booking there, led by Divi's Laboratory. But even the other names like Sun Pharma, Dr. Reddy's, Cipla, weaker in trade. You've got FMCG names like Britannia, HUL, Nestle struggling. The Nifty FMCG Index is down nearly about 0.5%. And keep your eye on the global markets. Europe is weakening in trade. The DAX is down close to about 0.8%. The Dow futures also lower by nearly 160 points. So the picture across the global markets is a bit murky.
What you're saying on Europe is actually quite surprising, because the earnings have been okay. I was looking at some more commentary. The automaker numbers there are pretty okay. I mean, there's nothing immediate. There's German inflation data that's come out. Inflation continues to cool down. So there's nothing apparent which seems to be going wrong, but prices are reacting quite severely across Europe, and we'll keep an eye out on that.
Well, that's right. And Rima spoke about it being a rather dull day, but maybe, in fact, if we were to see some action, then we're perfectly poised, right? Because the final 60 minutes of this weekly expiry will play out. It's Thursday, so normally you have the weekly expiry that plays out. So let's look at the broad range we're looking at. First, let's get the range up for you in the screen. Rima said we're moving in this 50-point range odd. Well, we'll get the range for the final 60 minutes odd. There's 17,570 on the downside. On the upside, 17,630. And this is the range, I say, because the options data is suggesting that. We have two strikes that are very, very active. 17,600 call, that's very active in today's trading session. 17,550 put as well. Both of them are very active in today's trading session. Remember, the call earlier today was, don't go to jump and chase that gap up. That got sold into, so good that worked out, because at one point of time when we started off, we were up 50, 60 points on, and we've come off those highs. I think at some point of time, we could get some of those options data is up for you, but we should keep an eye out on that. Broad range, 17,570 on the downside, 17,630. If this range breaks, then we could easily see a spurt either which directions, but for the time being, that's the positioning.
Since the range is not breaking, I think people have decided, okay, let's stop thinking about the index levels. Let's just get on with life and get to stocks, because that's what's happening. I mean, again, don't look at the mid-cap index, because the index even over there is absolutely flat. Both mid-cap and small-cap indices are flat, but there is intense action in that market, the broader market. And I'll just point out some stocks as an example. First of all, in the so-called mid-cap mania that seems to be going on, there's a huge consumer element to it. Whether you're looking at innerwear companies, or you're looking at footwear companies, or you're looking at hotels, there's hectic buying across the board. Let's pull up some of the names. There's Lux Industries, Rupa, Dollar, high single-digit gains to double-digit gains in some cases. Relax was probably not the one that's really participating. Pull up Mirza International, put up some of the other names like Liberty Shoes. Last time I checked, Liberty was up almost 20%. So big moves over here. Shoppers Stop is up about 6-7% as well. Mirza is on a 10% circuit. That stock's up 65% in this week. So that's the kind of accumulation that seems to be going on. Indigo Paints is having a great run today. It's up almost 10%. The entire rail, not the entire, but a large part of this whole rail part of the market is buzzing around. Not quite sure if the market's smelling another big order, potential tender. But some of those names are on your screens. Titagarh is not alone. The point I'm making is there's Concor, there is Texrail, there are a couple of other stocks as well which are participating in the rail rally. Not NMDC. NMDC Steel is the one that we need to look at because that's again where the price and volume action is extremely evident today. So all in all, Mangalam, it looks like traders are saying, well, mid-cap markets are where the action is, and that's where we will be as well.
Mid-cap is where the action is. That's what traders are saying. But what's interesting is, the stocks that are moving, they have actually seen a big correction from the highs as well. You spoke about Liberty Shoes. It's down about 40% from its 52-week high. And at the same time, it's prone to these big, inexplicable rallies in the past as well. Last 15 years, I remember the stock has gone 3 times, 4 times in a span of a couple of months, and then over the next 6 to 8 months, it consolidates and falls from the highs. That's one. Lux Industries down about 44-45% from the highs. Indigo Paints as well. One of the underperformers in the painting space, down about 33% from the highs. So maybe these stocks which have seen a big battering in the past are the ones which are finding some favor. But just as far as the markets are concerned, the low on the Nifty today extremely crucial, 17,587, and that compares with the 200-day moving average of 17,590. So which is where we've seen a bit of a bounce from. So the first test of the 200-day moving average today was defended. Let's see whether that continues to stay defended as we move into the expiry hour as well. But on the way up, 17,684, today's high. Again, the Nifty range of 100 points is what's playing out. Whether we break out of that or not, there are 3 ways, 3 things that could impact the market. One, the mid-cap outperformance. Does it translate itself into the large caps as well? Secondly, the Nifty Bank is outperforming, though off highs, but does its outperformance continue? And the third most important one is the IT pack, because weakness was expected, and weakness is something that we saw in the IT index and the IT stocks over the last few weeks. But, Mastech's numbers and HCL Tech's numbers post-market today, can that make a bit of a bottom in the IT space for the near term, and can that support the frontline index or not, is something that could be a big trigger for the indices going forward.
Okay, that's the picture so far. Let's see what the next 1 hour has in store for us. How should you position yourself technically? We've got Mitesh Thakkar joining in. Mitesh, so far at least, we've managed to respect the boundaries that the markets put in place, still holding within that 300-point range. And on the way down, that 17,570 mark is still holding on the Nifty, even though we've been slowly grinding lower over the past couple of days. What is the trading call now at the index level, and any individual trading ideas that you would recommend?
Good afternoon, Nima. I think you rightly highlighted nothing much has changed for the index. In fact, if you look at the numbers today, yesterday we got a high of 17,666. Today it's about 17,685, so 20 points higher. And then yesterday's low was 17,580, and today is 17,584. So practically, we are trading yesterday's range. Not much has changed in the indicator scenario as well. But I think, as I said earlier, if 17,550 doesn't break, I think there's a good chance that we will eventually break on the upside. And I still maintain that view. So we're trading with long bias on stock side, despite the fact that our view is that the broader index will consolidate, and the mid caps will mildly outperform along with the financials. So that's the way we'll approach the market right now. I have a buy on Bandhan Bank, which I would recommend buying with the stop just below levels of 212 for targets of 230. And Bajaj Auto and auto names have been clearly doing very well in the last few weeks. So Bajaj Auto is also on the radar. So buy with the stop at about 42.85 for targets of 43.80.
All right, Mitesh, thanks a lot for that. In fact, it's a bunch of the second-tier stocks which are doing extremely well. I mean, on the front line end of things, we have weakness in HUL and Nestle, both of them at the low point of trade. But, flip that, look at the F&O space. We have Dabur, which has moved to the high point of trade, and giving it company is Godrej Consumer as well. That's the other stock from the consumption basket, which has moved to the high point of trade, even as we see some profit taking in the likes of HUL and Nestle. And, I mean, that's how bulls and bears work, right? But talking about bulls and bears itself, there is an interesting case that is coming for Cummins, which is both a bull case and a bear case. Kotak Institutional Equity has a buy on the stock, whereas Bank of America is in the bear camp. They have an underperform rating. But I won't take Nimesh's thunder away. Nimesh, a bull and a bear case on Cummins.
Well, it's a classic bull versus bear, and we all know in the market, right? For every buy there is a sell, and for every sell there is a buy. And Cummins stands out today. The stock is up 3.5%. Among the big F&O gainers in today's trade, and largely, because of the Kotak note which came today morning. Now, Kotak is arguing that it's a top call for them. They have a buy rating and a target price of 18.10. Not only that, they believe it's a structurally well-placed Cummins, and the recent announcement by the parent to invest $1 billion in the US unit do suggest that there is a possibility of an outsourcing order coming to the way of Cummins India, and that could be a big trigger. Also, if you look at the margin gap versus the peer for Cummins, it really shows that the business is on a high scale. There is longevity as well. Localization is happening, and they're gaining market share in the high margin business, and that bodes well for Cummins margin going forward as well. That's the Kotak's argument. Now, they've retained their estimates, and they expect a 16.5% revenue CAGR between FY23 and FY25, and close to 18% of margin and 26% of ROE by FY25. So that's the Kotak argument, which is on the bull side. If you remember last week, I had highlighted this as a standout as well. BofA Securities downgrading the stock to Cummins to an underperform, and it was a kind of a rare, downgrade coming in on Cummins from the sell-side analysts. So they downgrade to underperform. They've cut the target price to 1434 versus their earlier target was of 1758. Now, the downgrade from BofA was in 4 key reasons. The first reason being 50% of price hike in the CB 4 plus norms, which is going to come. That's going to have an impact on the overall sales starting Q1 of next year. So that's a big worry for them. Second, for FY24 and FY25, the growth estimates which have been penciled in by the market, it actually bakes in the pre-buys because of these orders, and that's why they believe that relatively on valuation there is not much upside left. Third, in terms of the exports, now 1/3 of the revenues come from exports, and that's where BofA believes there could be a disappointment because of the global slowdown. And most of the margin expansion which came in the last 4 quarters, close to 560 basis points, that seems to be pretty much done, and from here it could be a challenge. So given all this, they're downgraded. But as I said, for every buy there is a sell. Kotak today believes that it's the best pick for them, and they retain a buy, whereas last week we saw BofA sharply downgrading the stock to an underperform and cutting the target price. So 2 different views from 2 different brokerages.
Okay, Nimesh, got that. Buyer and seller, that's what makes the market. Thank you for getting us both sides of the story on Cummins. So that's a stock that's up about 3.5% as of now. Let's welcome our first guest on the show. Deepak Shenoy is joining in. Deepak, always a pleasure having you on the shows. We seem to be getting into a very interesting market, right? We've been discussing this right from the morning here, all of us, that the index is very, very range bound, but there's plenty of money chasing stocks now, particularly in the mid-cap market. Mid-cap index itself is up 4.5% this month, while the Nifty is flat. Your thoughts on this trend, and any specific theme that's catching your eye? For instance, consumer. Look at consumer today. Whether it's liquor stocks like a Sula, or whether it's innerwear stocks, shoe stocks, there's a lot of the consumption story that seems to be finding takers in the mid-cap market.
Well, you're right. I think, the mid-cap market itself, I think there has been underperformance in the last year. And then you also had a massive correction in the PE ratios. If you look at the mid-cap index in itself, they've come to much more reasonable levels now compared to earlier. Usually, the mid-cap index PE ratio used to be much higher than the Nifty. Now they're comparable. So in that sense, there's been a correction. And then you're also seeing that there are a few mid-caps. And I won't talk about the index itself. The index is, for instance, it's flat today, but there are lots of mid-cap stocks that are up considerably. I think the idea is a few stocks are going to are going to get a lot of benefits from some of the larger trends that seem to be happening. You mentioned rail stocks earlier. There's the benefit of the orders are going to mid and small cap rail firms. Relatively much higher than their market cap is where their order flow is coming in. We're also seeing a small shift in auto as well. In auto ancillaries, the mid caps seem to be doing better. The auto majors, which are mostly large caps, are not doing that well themselves. So there is, I think, a valuation correction that has happened over the year, and potentially people are expecting much better earnings. Now, whether those earnings actually happen, we'll see soon when the results come out. But so far, to be honest, there's nothing been so encouraging about the results that gives a feeling that, everything should get re-rated substantially upwards. I think the mid-cap space is the one that will make a lot of money for investors longer term. But, right now, nothing to write home about, at this moment in time. Maybe results will change my mind.
All right. Hi, Deepak. Good afternoon. Clearly the street is expecting something from the pharma stocks. And they have been big underperformers. Today they're come in for some profit taking. But in the last 1 month, that's been the outperformer. What's your view? Any stocks out there are meeting the criteria according to you? Margin improvement is something I think the street is working with. And a couple of notes indicate that now valuations in comparison to the past are pretty much in line or at a bit of a discount. Your take?
Yes, indeed. I think I think, Nigel, is where the summary of it all. They expect higher, I don't know about margins, but definitely higher revenues because the export figures came out earlier this month, and then there was some positivity on that. I think the margins will actually contract, but I hope I'm wrong. There's another part of this activity, which is, the FDA. So this may not apply to all pharma companies, but FDA activity has increased. We are seeing a lot more in terms of both warning letters and approvals and all that stuff that's happening. So there may be some positive, but I think largely negative surprises from an FDA action move. We're so close to results that I don't want to take a call on whether things have actually improved for the sector. So I'd rather wait. We haven't seen any major pharma company yet announce results. So we're on a wait and watch mode here. I think the price action is favorable. Things obviously insiders and certain other people will know more about something like this. And the pharma pack has been beaten up quite a bit. So some part of this correction may just be a pullback because they've been beaten down too much. But for earnings to have to follow, I think, the numbers will have to do the talking. They aren't yet doing any talking. I mean, they aren't released yet, so we don't know whether they will.
Okay, Deepak, I remember you having strong views in the new age business space, but over the last couple of days, we've had a couple of brokerage notes. I mean, Zomato, for instance, the revised payout schemes that they have for Blinkit is likely to be margin accretive for them, rather less capital intensive for them to go ahead and increase and improve their business. Motilal Oswal initiated coverage on Zomato. And this morning we had a note come on Paytm as well. With all these brokerages getting incrementally positive on these stocks, and at the same time the belief that interest rates are near peak as against near bottom, do you think these stocks warrant a fresh look?
So I mean, to be honest, I'm all for new age businesses, and particularly I cannot comment about Paytm. We're not allowed to. But here is the gist of, I think, where the things are going. They all have to move towards profitability. I think all of them are making moves toward profitability. Some, whether it is a Policybazaar or Zomato, the core business of, in Zomato's case, food delivery, has started to show some signs of improvements. The Blinkit acquisition is what threw us off a long time ago. I wasn't able to, at least in my head, make any sense of 3,000 crore kind of effectively putting bad money after good into a business which is, I don't think it has the ability to deliver good margins. So while their core business improves, this might drag them down. So you can have adjusted whatever the numbers. The word adjusted comes in so much that it becomes a meme by itself. But I think in the end, you have to actually have core profitability. If they can't get to that, all these businesses will suffer. And it's good to see that they're making strides towards it. What you have to remember is if any of these businesses need funding, and they're listed, they have the option of going to public markets and demanding maybe a smaller follow-on public issue or a rights issue and so on. But the ones that are private are in more trouble because the community around investing, although rates may not go up much more, they're likely to remain at this level or around this level for at least a year and a half more, at least in the US. So I don't think a company that's going to be bleeding a lot for a lot longer they have to actually move and evaluate the chances of survival. So this may affect more the private sector than the publicly listed companies, but that's how the landscape is right now.
All right, Deepak, thanks so much for stopping by, discussing those stocks. And in Zomato, I think some part of the street is waiting for their latest shareholding pattern. We're hearing about some probably big names coming in there. So let's see whether or not that happens. And interesting to see who goes out as well. So the shareholding pattern as well is something that the street is keeping a close eye on. For the time being, though, we'll slip into a short break. On the other side, our Alpha Manager of the Day, Harish Krishnan of Kotak AMC, will be joining in. We'll also be joined with management of Mastech to discuss their Q4 numbers.
Welcome back. Here with us on Closing Bell, and our next guest on the show is with us, Harish Krishnan from Kotak Mutual Fund. Harish, thank you for joining in. Always a pleasure having you on the shows. Now, I was just trying to go through, some of the funds that you manage. Of course, you've been managing the Make in India Fund, or the Manufacture in India Fund, I think as it's called. You've been managing the Infrastructure Fund at Kotak for a very, very long time. So my question is this. I think it's a no-brainer. Everybody knows that at least on the defense side, on the railway side, there's a lot of ordering, there's a lot of spending, and the numbers are showing up. But beyond that, what are the themes within manufacturing that you are really convinced on? For instance, we were just discussing some of these stocks today, Cummins, Concor, and some of them actually make it to your portfolios. They have a sizable holding over there. So tell us your thoughts, and what are you buying, let's say, beyond railways and defense?
Sure. So I think infrastructure is a varied theme, straddling some of the names of railways, defense, for sure, a lot of government beneficiaries in terms of government spending, but it also straddles names like auto ancillaries on the manufacturing side. It also straddles names like real estate, cement, utilities, gas utilities. And therefore, when you look at it in totality, we do think that, we're excited for sure. The government spending continues to remain robust as far as investment and capex is concerned. But I think what we are incrementally seeing is private capex moving up into the right lane. I don't need to tell you that for the last 10 years pre-COVID, capex was in neutral or reverse gear. And, for the longest period of time, for the listed companies, for example, capex in aggregate used to be in the 6 lakh crore mark. For the first time, we've crossed the 7 lakh crore mark. And more encouragingly, given the stronger cash flows that companies are throwing up, I think we definitely do see prospects of private sector capex inch up. So beneficiaries of that could be EPC companies, it could be cement or building material companies, it could be process-related companies, automation companies on the capital goods side, etc., which definitely make the mark and the cut in our portfolios. Similarly, if you were to look at, say, for example, sectors which haven't really performed as well as we would have liked over the last 2-3 years for various reasons, one such sector that stands up is cement. Where clearly there has been an issue in terms of both a newer player coming into the fold, as well as more importantly, the issue of high energy costs plaguing the sector. And clearly we are starting to see energy costs stabilize, and therefore we do expect profitability to improve quite meaningfully for that space. So I would say that's another space that we are keen on. Similarly, in terms of gas utilities, again, there's been a space which got impacted significantly by the Ukrainian invasion by Russia, causing a spike in overall gas prices, and things are starting to come through. So I would say a lot of those places, building materials is where also we are positive about, other than the government beneficiaries of railways and defense.
Okay, all right. Hi, Harish. Good afternoon. Good to speak to you, hear your thoughts, track you on Twitter as well. You know, Harish, the last time we chatted, you had indicated that pharma is a place where you're allocating more money out there. And you also highlighted the contribution coming in from pharma stocks is the lowest in terms of profitability to what we have seen in the last 15 years. So good call is what you've made out there, because in the last 1 month, well, pharma has done pretty well. What's your stance now? Do you believe the best is yet to come? Obviously, you're managing a lot of money and you're buying some of these stocks for a longer duration of time. What's your view on it?
So I think the latter is the most important thing when you track our calls. Clearly, we are not managing for the next 1 month or the next 3 months. And a lot of the basis of that call was primarily, as you rightly pointed out, over the last 20 years, if you were to plot the pharma sector profits as a percentage of total profits, it's one of the lowest that we are currently at. And therefore, we do think that given the inherent nature of pharma as a defensive compounding kind of a sector, we do think that we are getting it reasonably at a much better place, wherein we think that there is a good chance that earnings can rebound over the next 2-3 years. So I am of the belief that, after a series of 5 years of underperformance, we are likely to continue to see, the prospects of this space improve as we go through the next 2-3-4 years, and which is where our overweight stance on pharma now is predicated upon.
Got it. Harish, afternoon, Rima here. I remember our last conversation, or one of the recent ones in the month of February, where you said that on IT, you cut your underweight and you turned neutral. Well, since then, things have turned negative. The management commentary has changed. The macro environment is far more uncertain, which gives no visibility to the IT companies about at least the near term. Your thoughts on IT and what we've seen in terms of numbers, and what, according to you, is the way IT is going to play out?
Sure. So you get some and you lose some. I'm saying in reference to the comment made by Nigel before. But I would say, broadly, when you look at, talking through the same lens, IT sector profit pool as a percentage of total profits today are at close to about 9%. Just to kind of refresh memories of most, IT has been one of the biggest wealth creators and one of the biggest earning pool expanders over the course of the last 2 decades, clearly. The number used to be about 4-5%, post the dot-com bubble burst. And from there, it went up to 8% of overall profits in terms of when the GFC crisis unfolded. And post that, it reached to about 12-13% pre-COVID. And from there, of course, during COVID, given the fact that there was a significant amount of pent-up spending that came their way, as well as margins, which got the benefit of some amount of spending reduction in the form of travel, this number went up to 15%. And from 15%, it has come all the way back to 9%. So our sense is that, and this 9% was last seen in 2013, right? So Macro and an uncertainty, etc. I really don't think anybody will have a greater call in terms of when things will get certain for clients to start spending. So our call is that can 9% go back to say 12%, which was the pre-COVID level? I would think that over the course of the next 3 years, there is a reasonable chance it can go there. What has actually surprised me more than anything else is not so much the revenue kind of deceleration. I would imagine that most of the street, including most market participants, would have kind of believed that FY24 would be a slower year. But I guess what has kind of surprised us is the margin contraction that many of them are guiding for even in FY24. And that is what has been a reset check. Now, whether it's been only for these 2 or 3 companies because it's been very early in the result season, or is it symptomatic of the entire sector, we need to watch out for. So I would say that we continue to have a neutralish kind of a view on IT. The only thing against going overweight on the sector is clearly valuations. They haven't reached levels wherein one can say that we can ignore these uncertainties and the macro niggles and take a far more positive call or basis valuation. So I think we are in a camp where earnings have compressed quite meaningfully. We need to go through a phase of consolidation. Maybe valuations can contract some more, and maybe macro can turn around much faster than any of us can think of. And therefore, we continue to have a neutralish call on most of our portfolios as far as IT is concerned.
Right, Harish, hi. Just wanted to know your thoughts on the banking, rather the financial space, so to say, because in December, when things were looking extremely good from a price performance standpoint, you said it's a prudent time to pare some profits down, both public and private sector banks. Then after the underperformance in February, you said the same conversation where you cut your underweight on IT, you also cut your underweight on financials. Now, where do you stand on banks, and do you believe that NBFCs, outperform going forward as compared to banks?
So I think deposits continue to remain a challenge for the overall banking system on the liability piece. And over there, I would think that franchises which have very good deposits franchise or the liability franchise will make a mark out. So there are for sure some very well governed and very well managed NBFCs which have access to good liability franchises. They can definitely do well. Along with that, we do think that private sector franchises as well as select state-owned banks, which clearly continue to have a very strong recall as far as the liability side is concerned, I think they'll stack well. Just to kind of refresh, I mean, the only limited point that we were saying was, we had seen the best of everything that came through in the form of credit growth, improving. We'd seen margins at significantly highs and credit costs which were significantly low. And therefore, from a Goldilocks kind of a scenario, we do think that over the course of the next 12 months, one or maybe potentially 2 of these dimensions may see some slowdown. It doesn't mean that things will become very bad, but at the margin, things will slow down. After the underperformance, we have kind of reduced a lot of that underweight, but we do think that it's going to be far more gradual. And within the overall financial space, our focus is to back into the franchises which have very good liability access at this point of time.
All right, Harish, thank you for joining in and giving us all those details, your views on a multitude of sectors. Always good to hear your views as well. Before we move on, just keep an eye on the markets because it's the 3 p.m. Time for the 3 p.m. move, so to say. But, nothing's really happened. The Nifty absolutely flat, as is the sensex and the mid-cap index. The Nifty bank continues to outperform just a wee bit. A couple of mid-caps, worth mentioning. Indian Hotels has now moved to the high point of trade. Cummins, something that Nimesh spoke about in the bull versus bear segment, now has moved to the high point of trade. And in the FMCG space itself, we're seeing some traction in Tata Consumer as well as Colgate. Both of them are doing well, are moving towards the higher end of today's trading session. But those are a few stocks which are buzzing around in an otherwise flat market from the frontline end of things. So good time to get in what the D-Street chatter is. As always, Nimesh joins in. Nimesh, yesterday you said there was a lot of activity that was taking place beneath the surface while the markets on the frontline end were comatose. What are your thoughts now?
Today looks like a quiet day. That's the overall feedback, that the flows are muted, the activity, but it's very much in the broader market, and that's what looks like. A lot of the retail interest seems to be back. It's not backed by institutional support, whether DIs or the FIs. So there are so many sector stocks which are doing good. Your shoe companies, your innovative companies, a lot of things are buzzing in trade, but there is not much in terms of institutional support. That's the feedback. Must be a lot of retail activity which is picking up in that particular space. I also checked with a lot of buys on whether any of the fund got launched, and by virtue of which there is some bit of buying risk. But even that seems to be not the case. So looks like purely a retail interest in the broader markets. Even in terms of flows, as I said, it's mixed, but again with a negative bias, and some bit of selling in IT, select banks do continue. I guess from a profit booking point of view, the cement and pharma is where I guess there is some bit of profit booking as well. But again, not much in terms of flows, so to speak. So dull day as far as volumes are concerned, but there is a lot of activity in the broader market, which explains the retail hand seems to be quite active in the broader markets.
All right, so let's talk about those broader markets and specific stocks itself. Where are the buys and sells?
So in terms of large names, two stocks stands out for me today is Biocon and Marico.
Okay.
Not much in terms of stock price reactions, but in both the stocks, the delivery volumes are going to be quite high, and I believe that selling supply from larger institutions continue in both these names. So that stands out for me today. The second stock is HDFC Bank. After a long time, some bit of bank seems to be back in that particular stock. So every day within the financial names, that is to stand out on the sell side. Today, for a change, after a long time, I'm seeing some buying flows, some buying traction in HDFC Bank. So that's the second stock. And the last stock is Fusion's Microfinance. A couple of days back, there was a report from ISEC as well. They've put out a note. That stock is relatively under pressure today, but there is a strong buzz of a large block deal coming in very soon. I was looking at the shielding pattern. The potential seller could be a private equity, but again, it's classified as a promoter. So looks like it cannot come before the earnings season, because now everything is in a pull off. So maybe, but maybe after that, maybe you might say a large block from a private equity in Fusion Microfinance, and hence that stock is under pressure today.
All right, Nimesh, thanks a lot for that. That's about Fusion Microfinance and a bunch of other stocks that he's been tracking. We'll keep an eye out on that, but otherwise it's been extremely quiet, as Nimesh pointed out as well. It's 3 minutes past 3. No 3 p.m. move, so to say, has come by. We're flat. So what we'll do is take a short break. On the other side, we'll get you whether you should buy something today or for a reverse trade tomorrow, and or sell something and buy tomorrow as well. Mitesh Thakkar joins in.
Welcome back. Well, we're almost closing down on trade. We just got around 25 minutes to go, and the markets have not moved. We're as flat as can be. The Nifty has not moved a single point, so let's see how things go. Mitesh joins us. Mitesh, what a day, right? We're traded in a range, but today it seems inside days, I think so, right? I mean, in technical terms that you guys talk about. But your view of the index, and give us some buy or sell calls that you have for us.
I think, Ajal, till we get a good condition on the upside, or we break 17,550. I think one, we maintain the positive bias, and two, I think stock specific is the way to trade. I think the index might not do much, and as you rightly highlighted, I think it's been a market which is very contracting today, just around the range of yesterday's. And on the stock side, I have BTST on CUB, or that's a BTST with the stop at 131 for targets of 135. And Bata is the other one. That's a BTST with a stop at 1445 for targets of around 1475.
Okay, got that. Thanks very much, Mitesh, for that. Well, the next couple of minutes, we'll have the Mastech management join in. That's really not just the stock of the day, it's also the story of the day from a financial market standpoint. Because this growth that Mastech has delivered, over 5% constant currency growth in an environment which is so uncertain, has been nothing short of breathtaking, and perhaps that is the reason why the market has handsomely rewarded the stock. In fact, I think we do have the management joining in. As I mentioned, the company has seen an over 5% constant currency growth. Ashrank Desai, Vice Chairman and MD of the company, is joining in. Mr. Desai, good afternoon. Great to have you on. You've hit all the high notes and the headlines today. With a performance like this in an environment where a lot of the big boys of the IT world have scared the street. First things first, where has this, I think 5.3% constant currency growth, where exactly has this come from? I know that UK and Europe as a geography has done very well for you, but give us the color, because some of the bigger companies are talking about ramp downs, deal cancellations, deferrals. You've not used much of that commentary.
Yes, thanks for coming here, inviting me on CNBC-18. So, yes, what you say is right. The main growth happened in UK and European markets, and to some extent in the Middle East too. So our business is digital engineering predominantly in UK, and also Oracle implementation, but it's a smaller portion. The digital engineering business is driven certainly by our large government platform sign-up that we have done over last many years. So certainly an investment was going on in terms of getting business in UK. And some of that investment, which we were making in sales and marketing area, in terms of deals, in terms of our value proposition, seem to have paying off now. And some of that impact came in this quarter. So we did much better than last 3 quarters. So some of it is investment. But having said that, as you know, we have 3 pillars of our growth. One is digital engineering, digital transformation business, other is Oracle cloud business, and third is the Salesforce. Now, all of them are that way relatively faster growing sectors. Digital cloud is a faster growing business than non-digital and cloud, and ours being almost more than 90% in that area, in those areas, does help us to keep the traction moving.
Right. Mr. Desai, just to get some clarity, were there any projects of yours which were paused or deferred? And did you face any project cancellation? And if you could provide this answer geography-wise, in US, any project cancelled or deferred? And similarly for UK and Europe and Middle East as well, if you could give us, this answer.
Yeah. So, Rima, predominant postponements are happening in US. The order books that we, for example, did in Q4, many of them could have come in Q3. The Q2 orders should have come in 2, and some of the quarters, this quarter, the orders got delayed, postponed. So predominance of postponement is happening in US. So that's first. Having said that, I'm not saying there has not been any postponement in Europe too, although we had a very good order book in UK also, but there were few postponement in UK also. Not seen anything much in Middle East. So, as I said, summary is US focused postponement, and mainly the decisions are about how to move ahead. No cancellation. We have not seen any cancellation so far. I think our clients are, yeah, please.
So no cancellation even in US, right?
No.
Okay. And so how many...
Yes.
And how many projects have gotten postponed or deferred? And have they given an indication that they want to restart the project 3 months down the line? Or is it going to be deferred, say, 12 months down the line? Any indication on when they plan to press the pedal on restarting these projects?
That would really depend from customer to customer, I would guess. But what's really happening is there is obviously the overhang of whatever forecast that is being made about US economy and global economy. So the customers are really looking at doing project in a different way. For example, they could do a project where there can be more components of doing back in India compared to doing it in their country, which will reduce their cost. So that is one part. The second part is they could look at reconfiguring or reprioritizing their project, something that they thought they could do next year, maybe they can relook again. So some of these decisions, which are really internal dynamics, which is taking time. So really difficult to predict. But having said that, we have seen project moving 1 quarter. That we have definitely seen.
Right. So projects have moved a quarter. The non-US business, the UK and Europe business, just wanted to understand if they can continue to grow at the 10% quarter-on-quarter mark as they have been growing. And you've guided for higher than industry growth. In your sense, what is it that the industry can grow at, and how much higher can you grow beyond that?
You are asking me US growth in the US market or a global market? Not could hear you properly.
Global market and also US market, but at the same time, the growth that you have in your non-US market, which is UK and Europe, can that continue at 10% plus?
I would not like to give any guidance along those directions. Some of these executions happen on the order booking that happens in a particular quarter, etc. So, however, we would like to see the growth momentum continuing. I would not like to commit any growth numbers, which is, numbered like this. However, having said that, we do feel that we would do better than industry growth, at least in some of our countries and regions.
All right. Mr. Desai, on the US market, I think it contributes around 26% of your total revenues, right? What's the strategy to scale that business? What is the mix you're looking at from the US business? Because I think you've hired a couple of top executives out there.
Yeah. So, Nigel, what we have done is we have hired a new president of US.
Yes.
He comes from a big experience of last 25 years or so in various leading IT companies. So that's one thing we have done. Second thing we have done, as you know, and that's not a news, it is a 9-month-old story. We have invested in a Salesforce business.
Mr. Desai, we have got a couple of these highlights. So given the kind of focus that you've done and the Salesforce, the new recruits as well, my question to you is, where do you see this business scaling up? I ask you this because at a time when some of your peers said is a little bit skeptical about scaling up the US business, but you have gotten some big names in there, so you're clearly looking to scale it up. To what level are you looking to scale it up, and what is the outlook out there? Very quickly, sir.
Again, as I said, we do not want to give any specific guidance in US versus UK, etc. But given our portfolio of present business, if you look at, is heavily in the cloud area in terms of Oracle business and Salesforce, which is also related to the same space, we do feel that the investment cuts that are going to happen, if at all they happen, would be lesser in that area, because cloud movement is something that they don't want to postpone. So our hope is that postponement of investment that happens hopefully will be less in the areas that we are presently in. That is the positive, shall we say, hope we have, is all that I can say right now.
So, Mr. Desai, just to get back to that point on growth, yes, you don't give guidance, but you're saying you will grow more than industry. Give us a sense. I mean, if you talk about industry, it depends on companies, right? Now, Infosys is saying between 4% and 7%. So, if you look at your peer set or the average IT services world, what is the average growth rate that you are going with, which you are, of course, saying that you will better. And I wonder if this will be all organic growth, or do you have some acquisitions in mind that could help you beat industry growth this year?
See, acquisitions is something, as you know well, it's very difficult to predict. We always look at acquisitions. As we speak, we look at them. So I would take that out right now. In the sense, I'll keep that aside. And I will talk of business that we have in hand as of now. So we are not doing any calculations that we will do so much acquisition. It may happen, it may not happen. So whatever numbers we are talking are actually our existing organic business, as you call it. Now, I agree that there have been various numbers which are quoted about the industry, and it depends from the company by company and size by size. All those variables are there. And that number itself may change as we move along, depending on the situation as it unfolds over next 3 quarters, sorry. The point I'm making, however, is our hopes are two rather. One, we have made certain investment in people, certain investment in fast-growing business like Salesforce last year, that means year that ended. So those investment in people, sales, marketing, and large, faster opportunistic business, if I may call them, should help us to do better than industry. That is the only hope I have.
So, Mr. Desai, just a quick other word which we didn't touch upon very briefly. What is happening on pricing right now? Obviously, in terms of volumes, you've done pretty okay. But in an environment like this, when clients are a little uncertain, at least in the US, is there a pressure on pricing that you have seen in Q4? Are you expecting that in the remainder of the year?
I didn't see any pricing pressure which I can say had impacted us in terms of our bottom line or new order books. Have not seen that such intensely. Yes, there can always be some contracts here and there where customer may have pressures. The only pressure that we have seen is uncertain decision-making environment, and that continues.
Okay, Mr. Desai, we'll leave it at that. Thank you very much for joining in. Congratulations on a good set of numbers. So that's Mastech. The hope is to grow faster than the industry. They've not seen any project cancellations. There are deals which are getting deferred, they're getting paused, but that's mostly happening in the US region, in the US geography. In Europe, there are fewer projects which are being put on hold right now. That's Mastech for you. The other two IT numbers you should watch today, one is HCL Tech and the other one is Cyient. Both report numbers post-market hours. Quickly to run you through the expectations from HCL Tech. Dollar revenue growth seen absolutely flat, just up 0.2%. Constant currency revenue growth is likely to decline by 1.5% due to the normalization of their software business, which did phenomenally well in the prior quarter. That growth rate is not sustainable. It will come down in Q4, and that will hurt their, calculation. So constant currency revenue growth is seen declining by 1 to 1.5%. Margins too are seen under pressure, and they're down more than 100 basis points. The key for HCL Tech is going to be their guidance. Will they guide similar to what Infi did, which is 4 to 7%? That's what the consensus expectations appear to be. And the question is also on margins. Now, HCL Tech is going to end FY23 with margins of 18 to 18.5%. Can they at least up the upper end of the margin guidance band? Because typically HCL Tech's margin guidance used to be 18 to 20%. Last year, their margins came under pressure due to an unnatural increase in the wage cost, bonus and increments, etc. So can they revert back to their usual margin guidance range of 18 to 20%? That's going to be tracked very closely. So that's the rough expectation from HCL Tech. Let me invite Anand Tandon on the show now. Anand, do you look at Mastech? It's a small company. Market capitalization is less than 6,000 crore rupees. But is this a company that you've seen in the past, and your thoughts on the numbers?
Well, I have seen it in the past, but it kind of dropped off the horizon a bit. I was just looking at the analyst, the presentation that the company has put out. So, clearly the quarter has been very good, but if you look at the full year performance, it is actually less than what it was for the previous year. So the real challenge is to see what it is going to do over the next couple of years. For the moment, it does look like it will have significantly higher growth rates, given the nature of the projects that they have, which are largely government projects, assuming that there are no issues in terms of payment recoveries in some of them. Government projects are notorious the world over for having problems in terms of getting people to sign off on achievements that are on the milestones that have been delivered and getting payments for them. But given what we are seeing on the face of it, it does look like the growth rate for the next couple of years may be much higher than the industry.
All right, Anand, I request you to stay with us for the time being. We'll just take that mandatory break. You come back and we'll have a few more questions to Anand, and also we'll wind down the market. Stay with us.
Welcome back. The Nifty Bank is up 140 points, 1/3%, and that's the only exciting part of the market. Otherwise, absolutely unmoved. I mean, it's so flat that you can go ahead and play cricket on the index intraday chart. If you just take a look at the Nifty from around 11 a.m. to now, it's been absolutely flat, virtually unmoved. Anand Tandon still with us. Anand, last week you said that it's a good time to get into the pharmaceutical and specialty chemical space. Since then, we've seen big moves. The pharmaceutical index has recovered a fair bit from the lows, individual stocks doing well. How much further is the runway for this pack, and what specific sectors inside of pharma and specialty chemicals would you be looking at?
So to answer the second question first, I think the API space is the one that one is really looking for. It does appear that the pressures in the US have eased considerably, and there is now significant demand growth that can be expected from that market besides everywhere else that one is looking. Also, the pharma sector, especially the API companies, have taken a huge beating. So valuation, so from a price perspective, they're also fairly, they're much lower than where they were at the peak. It's difficult to say that they are cheap only because of the fact that earnings have also got depressed. So, margins have compressed to a level where from here it's possible it may go up. Markets are looking firmer, price action in the market seems to be better, and the stock prices are at a level where the downside seems to be protected. So overall, that's my call on the sector. How much further is anybody's guess. I think one is expecting to see better numbers coming through. And those targets obviously on the upside will keep changing. The way I look at investments is that unless you have any fundamental reason to change, some assumptions need to be changed before you decide to move out. Right now, it's too early to say what those assumptions are that will cause you to move out, unless the fact that the earnings growth doesn't come through, is not what one is expecting, changes by itself.
Okay, Anand, hi, Surbhi here. Before we wind up our conversation, just wanted to get your thoughts on one specific stock, and that's Tata Motors, because there's so much excitement that's building up. Talk of them sort of generating perhaps more cash down the line in this year. Plus, there's of course the EV thrust on it as well. What's your view on the stock?
So, for the longest time, their international markets have been driving the company. And right now, it looks like that is still the major driver for the company. The thing is that it's already been anticipated that they'll probably reduce their debt by about $1 billion. And if that comes through, then, that's where the market is already positioning itself at. Clearly, the domestic market, they have done much better in recent times than they were doing in the past. The models are getting accepted, especially in this car space. And on the CV space also, their market share has stopped falling. They're doing reasonably well. So the domestic market is doing well, which is good news. International markets may pick up, and that's the anticipation that the market's really looking at. Debt will have to come down, but the whole joker in the pack is whether the UK market will not have a negative surprise, given that I don't think people quite understand that there could be a recession which can still come through. One keeps assuming that interest rates have peaked all over and therefore there is no chance of recession. The reality is there will be a recession in the Western world, and therefore having aggressive estimates from the global markets is not particularly a good idea in my view. It's already trading at a valuation which compared to its peers is not very cheap. So to the extent that it is one of the companies in the sensex which is going to show you the highest earnings growth, you can continue to hold on to it. But to think that because results are good, you should keep on buying more and more is paying twice for the same argument.
Okay, all right. Thanks a lot, Anand, for stopping by. Short but effective talk is what we've had with you. Appreciate you stopping by. Well, a couple of stocks, towards the end of trade who have really moved around. L&T Tech Services, just pull up the intraday chart out there. That stock has moved to the low point of the day, so some selling coming in there. While on the flip side, you had NCC that ends virtually at the high point of the day. But as we wind down markets, let's start with the headline index. We're virtually unmoved for the entire day. Not just the Nifty, but even the mid-cap index. I think both these two indices could actually end as flat, maybe without a single point move. So let's see how that goes. We'll get the average at around 332 odd. Stocks that were losing were some of the big gainers. Divi's Laboratories came in for some profit taking. A couple of these metal names, Hindalco, JSW Steel, both of them were under some pressure. And big boy HUL as well was down. The Royal Enfield as well was down 1.5%. On the flip side, you had NTPC. That one was up close to 1.5%. Adani Ports did pretty well. And Asian Paints, crude oil prices were a little bit lower overnight as well. So crude is unable to get past that $82 per barrel mark, which is good on the margin for paint companies. So that did pretty well. And Bajaj Auto as well was high in trade. But though the mid-cap index was more or less flat, as will be remarked, still we did have some winners and losers. So,
oh yes, absolutely. More action at the individual stock level. So I'll just talk about the ones that managed to show price and volume traction today. Mastek obviously is your stock of the day, almost 12% higher on good numbers. And then the stocks that we've been pointing out right through the day, whether it is Texrail, Texmaco Infra, NMDC Steel, Liberty Shoes, Lux Industries, a lot of these names on the mid-cap screens, that's pretty much where the accumulation in the action was. Count in Arupa, count in Indigo. Quite a few of the hotel stocks, by the way, did well as well. Perhaps people looking for summer holiday ideas. Lemon Tree, for instance, was up 4.5%. Railway was another strong story in the market. So a stock like RVNL, for instance, is going home with gains of almost 3.5% to 4% now, 4.5% actually. And you had some of the other movers and shakers as well, like a Cummins, like a Concor. Some of these stocks on the railway side, the engineering side, manufacturing side, they had a pretty decent session. Rima?
Well, just to add some more earnings reaction, Tata Communication ends with a gain of 2.7%, and this is despite the margins having missed the mark. The reason for that could be the stock had already corrected 6% in the run-up to the numbers, so the worst was perhaps in the price. So Tata Communication sees some green. ICICI Securities numbers look very disappointing, particularly in comparison to its peer Angel. So ISEC was down close to about 5%, and Cyient goes home with a gain of 2.5% ahead of numbers. But the final tick on the Nifty is at least a bit of green. 7 points up on the Nifty. On the Sensex, we're up nearly 65 points. Very, very quiet, flat, and sort of a dull session so far. We'll slip into a very short break. On the other side, big boy, Reliance's earnings are tomorrow. We'll get you all the key expectations. Stay tuned.
Well, it's a big day. Reliance.
Welcome back, and what a day for the precious metal prices, where you have the gold prices trading nearly 100 rupees on the higher side, and the silver prices nearly 5 to 700 rupees per kg on the higher side as well. So it has been a great day. The bit of a decline that we've seen in case of the dollar index clearly seems to be supportive, and this is a weekend that is about Akshaya Tritiya, where the markets are anticipating, even if some token buying, that also is on the positive side. The big downside to this Akshaya Tritiya, the industry tells us, is that this is not a wedding season. So you perhaps may not see that big jewelry, chunky buying coming in, but a token buying, investment buying is something that almost everybody is anticipating. This is what we've done in sense of gold prices in last 1 year, 19% of a jump. Well, just to remind you that we did see an all-time highs in gold prices also in the month of March itself, and that was to the tune of around 61,400 rupees per 10 grams. And we are trading at around 60,400 right now. This is where the gold prices were in the previous year for Akshaya Tritiya, at around 50,800. So 60,800 clearly is 10,000 rupees per 10 grams of a gain that you have seen. And that 2003 price I've just written to ensure or tell you on how the gold prices actually have moved in last 20 years. To the tune of 1,000% of gains is what we've seen. So almost from 5,500 to 60,000 is where we are trading in 2023. That is what gold has done in last 20 years. Should get silver on your screens as well. And in 2003, we were trading at 7,000 rupees. We are trading at 75,000 rupees right now. And last year, the prices were trading at around 61,000 rupees. So a big jump year-on-year basis, and for last 20 years as well. Just marking on what we've done in last 2 decades in sense of gold and silver there. Som Sundaram PR is Managing Director, India at World Gold Council, and he joins us now to talk more about gold and silver prices, the demand expectations, and what you should be doing this Akshaya Tritiya. Som, hi, as always, a pleasure having you at CNBC TV18. I first of all want to understand on what the ground situation is ahead of Akshaya Tritiya.
Well, you have already stated that high prices are actually keeping the consumers on the sidelines, I'm told. While there's a lot of inquiry, gold is now actually the focus of attention. People are not actually buying into this price yet. But most of the experts say that this is a good price to buy, and gold prices are slated to go much higher strategically and structurally. But retail will always take time to get used to this high prices. The good thing is, Nisha, dollar prices are not at their lifetime high. Still, they are still below 2,000. Whereas the rupee prices have just, as you have seen on the screen, have just shot through. They are almost near the lifetime high prices. So there is still some headroom in the INR prices, and which I think might attract some buyers. But as of now, what we hear is that the market is still at a discount. People are waiting on the sidelines.
So what really is the kind of discount that we're looking at right now, Som, for gold as well as silver?
Well, as you know, on silver, we don't comment on the prices, but Gold is, if I remember, it's at $10 or something and at a discount right now. But the more important thing is, during a time ahead of Akshay Tritiya, for the market to be at a discount shows the sentiment as well.
Oh, well, absolutely. So also, the other thing has been about the import numbers. With the first quarter just completed, what would you say about the kind of imports that we've done till time?
Well, as you know, last year has been pretty good. We purchased somewhere close to 750 tons. And this year started off with a significant jump in prices. So it is not any surprise that the demand did not pick up, and therefore it has actually shown up in the imports. I think at these prices, even the stores are looking at cutting down on the inventories, because that's the only way that you can save on labor charges not getting wasted by recycling, etc. So it's not a surprise. But I guess it will have to wait till the monsoons. We have always seen, Manisha, the fourth quarter can actually be a big surprise. If the prices hold out at these levels or even start moving up and the monsoons are good, you will see a very big jump in the fourth quarter. We have seen it in 2021, even after the second wave. The last quarter was one of the best in our data series in 30 years, 345 tons. So you normally wait for the fourth quarter, and that's what I would do this year too.
All right. So when you look at the last 1 year, and with 18 to 20% of gains that gold has given you, Akshay Tritiya to Akshay Tritiya, a lot of people in the markets tell us that they were under when it comes to portfolio diversification or having gold within their portfolios. A lot of also are lamenting, and they talk to us and they tell us that, is it too late really to buy gold at these current levels as well? At this Akshay Tritiya, what would you suggest? What would you advise?
Well, as I said, it's always good to have 15% in your portfolio, depending on the risk appetite, of course, what kind of risks you carry in your portfolio. That's what we normally say. And trying to time gold prices, gold buying based on prices is always wrong. As you have seen, last year, 50,000 appeared like lifetime high. Now, those who bought at 50,000 seem to have made a wise decision. So it's very important that when it comes to an asset class like gold, you start accumulating over a period of time, and you just don't try to time the market. It's never possible. At the moment, what we see, and as I have said, many experts say that there is still a lot of headroom for the prices to move up. But there will be volatility, but structurally, there is a lot of headroom for prices to move up.
So how would you look at the central bank buying record highs last year? The first quarter has actually been a follow-up on that further.
Yes, you see, central banks continue to buy, and that is also another very strong point for gold, actually. So the questions obviously are, last year, 1,000 tons never happened even during the gold standard, and now they're continuing to buy. So that definitely means that gold has a very significant role. Is probably going to have a significant role in the overall reserve management monetary system going forward. So therefore, these prices, that's why they said that, structurally these prices are attractive if you take a long-term view of gold.
So also, when you look at the investment, and during Akshay Tritiya, I'm assuming a lot of token buying would be happening, if not more. At 60,000, people are still getting used to, accustomed to these kind of levels. What would you say on is a better way of buying? Because when we understand that when you buy physical gold, you have to pay a 3% GST plus making charges on that. So the 60,000 rupees gold per 10 grams actually ends up becoming 68 or even 70,000 rupees per 10 grams if you were buying gold the same quantum.
Yes, I would say, look, unless you really need jewelry, and that's what consumers would do. Unless you really need jewelry, you're better off going in for even a coin or a bar. But more important is, you have obviously ETFs. You have digital gold these days. Of course, it is not regulated, but there are some reputed players. So you could buy those kind of things which are easy to liquidate if you want it, and then move into jewelry when you need them. Because the labor charges on those are also very low. And of course, sovereign gold bonds, as you rightly said, is one of the best investments, I would say, in any part of the world as far as gold is concerned. So if it is available, you should just go and buy the sovereign gold bonds as well.
So, are you surprised that we don't have sovereign gold bond tranche coming in during this Akshaya Tritiya? And also the fact that we've seen the first SGB buying, the redemption for 5 years just go through right now. How are you reading, on what's happening with gold bonds here?
Well, a sovereign gold bond, as I said, is one of the best asset classes when it comes to gold anywhere in the world. It gives you 2.5% interest and an upside on gold, tax-free. You can't get any better than that. I don't think physical gold can compete with that. But the question is, and I think we have issued an overall about 100 tons. The question is, has it met the original purpose of weaning people away from physical gold? Or has it actually added to the interest in gold? That's something that economists have to answer, because it has been very expensive, correct? If you really take the 2015 issue, it was 27,000 or 28,000, if I remember right now, and the redemption will be at 60, 62, whatever. So that is a big cost, and it is tax-free as well. So has that met the purpose? Is something which obviously it needs to be studied by the economists. I think that is one of the reasons why also we don't see too many issues now. But it is available in the secondary market for those who are interested. Small quantities though. But it is one of the best investments, I would say.
I'll wind up the conversation with one final question. So what is your advice to people who would want to go and buy gold? How should you be diversifying within gold buying as well? Is SIP a better way? Should you be waiting for dips to come in for gold? What is your sense? What is that one advice that you would give to buyers?
Well, I would always say that, look, don't look at, not having a GST. Oh, I saved 3.5%. Or can I get gold without a bill? I would probably be getting a cheaper gold. That is one way of losing money in gold. The best way is gold is a very good asset class. You have seen it, 50,000, including duty and GST. It has moved to 60,000. It will keep moving on because structurally gold is well placed. So the best way is to go and buy hallmarked jewelry if you need jewelry, or coins or whatever from reputed players, or go for ETFs. If you need better liquidity, go for ETFs and digital gold, and those products which the government has already placed in the market.
Oh, well, absolutely. And I can't gloat enough on the fact on the way the gold prices have run up. It was 50,000 rupees last year. It is trading at 60,000 right now. 2 decades ago, it was trading at 5,000. So from 5,000 in 2003 to 60,000 in 2023 is where the gold prices have come in. So clearly a huge return continuing from that one. So as always, thank you so much for joining us and talking to us ahead of Akshaya Tritiya and making sense of that asset class called gold. But with that, it's a wrap on Closing Bell. Thank you so much for watching.